Medtronic stock ticker MDT exceeded the last earnings call expectations with revenues of 8.5 billion and announced plans to acquire insulin patch maker EOFlow to expand its diabetes management portfolio. Year to date, they are up around 13.6%. They are trading at around $89 per share, but if you look over 1 year, they are almost trading sideways. They do, however, offer a pretty nice dividend, and as you can see on the dividend data history, consecutive years of dividend growth, 9 years, consecutive years of dividend payments, 44. And as you can see in the graph here, they started back in the early 90s and have since raised it numerous times to a pretty nice dividend of just shy of $0.7. But is it the time to buy Medtronic? That is what we want to take a look at in this video. So if we go into our stock screen and zoom in a little bit to see everything a little bit better, we have over here on the left the key metrics, such as the current price being around 89 as mentioned. Earnings per share is about 2.8. The growth over the last 5 years has actually declined, not something we like to see. PE ratio of around 16. The PE ratio 5-year average is around 32. I did, however, double check this number and it seems to be incorrect. So this is around 20, but still it's below its 5-year average. They are growing the revenue over the 5-year CAGR. 52-week high is around 95 and the 52-week low is around 75. They do have a very high debt level of 2.5 net debt to EBITDA ratio. They do, however, have a pretty nice operating margin, but over the last 5 years it's actually declined a little bit, which could indicate that the competition is pretty fierce in this area. The dividend is pretty nice. As you can see, it sits around 3% for the yield level. The payout ratio sits a bit higher at 96. I did, however, also double check this number and it seems to be incorrect as well. The actual payout ratio seems to be in the mid 50s, so also looking very strong. The 5-year and 3-year dividend growth rate is around 6 to 7%, also really strong. However, I don't really like the return on invested capital and return on equity we see down here. For return on equity, I would see this to be over 10%, and for return on invested capital, around 8% at least. So these two numbers aren't that strong at all from Medtronic. And if you jump into the dividend data and zoom in a little bit more, here you can see here what we're looking for is basically consistency. So what we see here is the dividend growth rate from the early years was very, very high, 42% and 17 and 18. And then it steadily dropped down to around the level that we see now, around the 8 to 6%. So compare the dividend growth rate for 10 years of around 12% to the 3 and 5-year growth rate, seems a massive drop. So in the future, maybe the dividend couldn't be grown at the same level they would like to, or at least have done so already. Coming down to the dividend yield theory graph, you can see on the 5-year dividend yield theory graph on the right, you can see that it could indicate that Medtronic is indeed undervalued right now. As you know, every time we go into the blue area above the dividend rate, then it could indicate a possible undervalue. And as you can see here on the graph on the left, you could actually maybe see around 19 to 20% discount at the current level, at least according to the dividend yield theory. But to back this up, we do have a lot of different valuation models. So let's jump into the first one, which is the dividend discount model, and zoom out a little bit more again. So what we have here is the discounted cash flow model. So we take the free cash flow from the different years. We then apply a growth rate into the future to project some future free cash flow. Using a discount rate of 9%, we then discount these future free cash flows back to a present value. Combining that with the free cash flow, cash and cash equivalents, the total debt and the shares outstanding, we arrive at a fair value of $62. Also using a dividend discount model, we do take the dividend payout from the different years, combining that with the combining a growth rate with the average cost of capital from the dividends, we do arrive at an intrinsic value of $62. Jumping into the next model, the multiples valuation, where we do take some of its peers from Medtronic, we then use their PE multiples to get a median PE we could apply back to Medtronic. In this case, we arrive at a stock price of $189. This should probably be taken with a grain of salt because as you can see here, the PE multiples are around 85, 90, 50, 53, 43. So it is indeed a very high multiple from the peers of Medtronic. But jumping into the next model, the price to earnings variation, we do take the PE ratio from the different years, we then average the last 5 years together. Using the EPS for the last 12 months, we arrive at an intrinsic value of $75 for Medtronic. Jumping into the last one, which is Graham's revised variation model, we do take the EPS from Medtronic, combine it with the PE of North Growth Company, the growth rate from Medtronic for the next 5 years, the average yield of AAA corporate bonds, and the current yield of AAA corporate bonds. Combining all those together using Graham's formula on the left here, we arrive at an intrinsic value of $23. Jumping into the free cash flow valuation, where we do take the price to free cash flow ratio from the different years, we then take an average of the last 5 years. Combining that with the free cash flow per share, we arrive at an intrinsic value of $77. The last model is the Peter Lynch model, where we do take the growth rate, dividend yield, and the PE ratio from Medtronic, combine that together using Peter Lynch's formula, we arrive at an intrinsic value of $26. Before we jump into the summary, thank you so much for watching. If you haven't done so already, please subscribe to the channel and leave a like. And if you like the new design of the stock screener, please leave a comment below as well. Now let's jump into the summary, where we do have the valuation methods that we just went through. All of them averages up to an average intrinsic value of $73. With the current price being around $88, the average current discount is actually a premium of around 20%. Using the margin of safety calculator we have made on the right here, you can see we start out with a standard of 25. We then deduct 10 for the EPS growth. We also deduct 5 from the dividend growth rate, but we do add 5 and 5 for the payout ratio being that high and also the operating margin being negative. As mentioned earlier, I did double check the PE ratio, so this should actually be removed. So the margin of safety we should apply could actually be around 15%. So if we put that in here, we arrive at an acceptable buy price of $62. Medtronic has actually underperformed the S&P 500, which could suggest potential headwinds. In my view, the stock could maybe only appeal to income-focused investors, given the robust dividend yields and also the pretty safe payout ratio. They do have a very strong free cash flow generation. But if you are looking into more long-term growth, I do believe there are much better stocks out there also in healthcare than Medtronic. So taking all these factors in consideration, if you do have a stock already, I would definitely hold it, but I would probably not go out and buy the stock at the current level. And this is based on the mixed financial performance and also some of the key metrics that we saw here, and also the intense competition they are facing. And there are a lot of uncertainties surrounding the expansion they are trying to do into the diabetes sector. So until there are more clear indications of some long-term growth and success for Medtronic, I would definitely wait out a bit. Thank you so much for watching, and I'll be seeing you in the next video.